Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about what we should expect for housing inventory and home prices for the rest of the year. First, I want to thank our sponsor, Optimal Blue, for making this episode possible. Logan, welcome back to the podcast.
Look at you in that background you got going on there, huh?
I love this. This is our new podcast studio, shiny new, part of our new office in downtown Dallas, and they have it all set up for us. So amazing, love it.
So you're gonna beat my Jack Nicholson portrait behind me, but speaking of which, for everybody who's listening, we're gonna have our first time. I'll be doing the Altos webinar. That'll come out on Wednesday. You can still register for it, where we talk about how to use our data line for your local area, your city, state, zip code, anything in terms of home pricing. Of course, I always believe everyone has to have their own model and show everything. That's what we strive to do every single week here. And it's been very interesting with the tracker data lately. So I think it's such fortuitous timing to have our webinar on Wednesday in Dallas for this event.
This is going to be amazing. Yes. And you will be in this studio. And then we're going to be doing, because you're here, we're going to be doing this podcast with both of us in the studio. That'll be really fun.
Oh, good. So I could like make fun of you face to face. People everywhere I go, people say, you need to be nicer to Sarah. I was like, you don't realize what she does, when the camera.
I can boss you face to face. It works both ways. So, well, we have a lot to talk about today. My gosh. Of course, let's start with home prices. Let's talk inventory and home prices. What do we see?
So it's been very interesting with our tracker data going back to mid-June. And again, we always say that we want to be current and we want to look forward on housing data. And when mortgage rates started to creep a little bit lower, nowhere near 6%, where 6% pricing is, or 6% rates have changed the pricing curve twice now since late 2022. But I noticed that things were stabilizing. And then July, the 4th weekend came, and that 2 weeks you have to discount it. And then 2 weeks ago, inventory fell in August. And the price cut percentage started to stabilize. And it's a little bit early for that to occur. Usually in the last few years, inventory would peak in October and November. So I was anticipating a little bit of a kickback of inventory this last week, and we barely got anything. Barely grew on the active inventory side on our weekly data. And our new listings data, like I could understand why new listings data was down year over year 2 weeks ago, but it's still down again year over year. And this is something that we're going to show this on Wednesday, but to think about going out in the future for the last few months of the year, if mortgage rates do go down to 6%, is this the third time now since 2022 that the pricing model changes? Because for me personally, it's like my price forecast was very low compared to everyone else's. And I need more weakness in pricing for my forecast to be right. Last year, I needed the same thing. I didn't get it because here comes September and October. It's September, October. Our data is going to show negative year over year home prices because last year we had a firm pickup and that ruined my forecast last year. But now we're going into this. So it becomes a little bit more interesting because supply is up. Rates are still elevated. They're not down to 6. It's a good tug of war now for the rest of the year.
I remember for like 18 months, every time we got on, we would talk about inventory, and it was just the worst story in housing because we just did not have enough. I mean, all the way back to 2022 when it was 240,000, houses for sale for the entire country. That was crazy. But I feel like we've worked so hard to get back to where we are. And then starting in 2024, and now this year has been so much better. So put it in context historically, the new listings, the inventory, where we are.
There's two ways to look at active inventory on historical context. The NAR provides their historical data lines going back decades, and their active inventory is about 2 to 2.5 million. Those are homes, though, that are in contract as well, and condos and everything. So their data line is going to be different than ours. The way we track it is we can track single family and condos, but for the tracker purposes, we do single family only. Single family active listings in March of 2022 were 240,000. The active inventory for the NAR was under 1 million. Here we are after the third calendar year of the lowest home sales ever, right? We had that waterfall crash in 2022, and basically sales have been flat really roughly since that time frame. But active inventory, the existing homes, is 1.53. That, is for me, it's a little bit meaningful because I always say that I can talk no more about low inventory if we could get inventory between 1.52 to 1.93 million. So I'm not generally a low inventory person, but we broke to levels that were very unhealthy. For our own data line, we're around 860,000. Normal would be like 1 million for us. And remember, ours is raw active inventory, no contracts. These are the homes available for sale. So we've made unbelievable progress that I'm pretty much done. And now the thing is, the seasonal inventory is starting to kick in. The NAR typically has their seasonal peak right about this time, June, July, or August. And then total active inventory falls until, winter is over and then you start the spring rise. For us, though, the last few years have been October and November. So having back-to-back weeks now, the cumulative would be negative. It's the first time. So these are things we keep an eye on because the new listings data is really starting to slow down so much that we've had back-to-back negative year-over-year percent. And remember, 2024 is the second lowest year ever in history. So here we are. We're going to finish 2025. And the new listings data ranged between 30 to 90,000 on a 5-year period, right? Seasonality speaking, when we get to the peak months, it's usually 80 to 100,000. That would be normal. We were only able to achieve that really kind of 1 year in 2022. We were able to break 80,000 this year during the seasonal peaks, but it was very brief. Only like 1 week we have one and then it declines, and we had another one, it declines. So the new listings data noticeably started to slow down after May. Again, and this is the difference between this housing cycle and 2008, because in 2008, our new listings data was kicking 250 to 400,000 per week for years, right? When Mike Simonson, the legend Mike Simonson, went to Lehman Brothers and told him, hey, homies, we have a way of tracking housing data that's a little bit different. And Lehman said, no, I don't know who you are. I have 85 analysts. Mike goes to Goldman Sachs, talks to Goldman Sachs. Goldman Sachs goes, uh-oh. They take the data, they short the housing market. They made $10 billion. Lehman Brothers went out of business. So we pride ourselves in fresh data, and it is a noticeable shift now since mid-June with our tracker.
So one of the things I've been hearing on social media from people that, from some mortgage lenders that I think are, tuned in this thing. One thing they're saying is like, yes, mortgage rates, in the last couple of weeks, we've been talking about the fact that they're at lows for the year, but maybe it's just too late in the season to make a huge difference. And especially if you're a home seller and you see things kind of sitting on the market and you feel like, oh, interest rates are still too high, I'm not going to get what I want, because people will have to factor that in, and they're just pulling their listings or not listing them. What do you think about that?
I disagree with that assessment for this one reason.
Okay, tell me.
New listings data is very seasonal. It always has its seasonal decline right about now. Now, of course, 2022, we saw an aggressive decline in the second half of new listings, but our biggest monthly existing home sales prints have all come in the winter. If you go back the last 15 years, not a lot of people know this, but if you go back, our biggest sales print last year was a really good example. Last year, new listings data was declining. Mortgage rates were just getting towards 6%. We had no year-over-year growth in purchase applications, but the week-to-week data was really positive. So everyone kind of said the same thing, that, well, it's late in the year and nothing. And I said, no, the week-to-week is showing duration. Like, you need 12 weeks, 12 to 14 weeks of like positive forward data to have a material change. Well, last year, we had a couple 100,000 more home sales. It came out of nowhere, they said. But no, the week-to-week showed it. 2022, starting from November 9th all the way to January, toward the end of January, early February, the forward-looking data got better. We had 12 weeks. It had one of the biggest month-to-month sales prints ever recorded in the history of America. We had almost 500,000. So we can grow sales and have new listings data decline, as that's been the case for over 15 years. The rate variable is the key if the forward-looking data starts to get better. And we've only seen that really from a period of time where rates go from 6.64 down to 6. And that long duration, we get at least 12 to 14 weeks of positive data. Last year, we had, out of the 18 weeks we were tracking, 12 were positive, 5 were negative, 1 flat. This year, the year-over-year growth, it was been solid all year, but the week-to-week, not so much. So now that we're below 6.64, back-to-back weeks, we're positive. We'll see how it goes for the rest of the year. But it is fascinating to see that, every single year we have something that happens with the tracker, and it typically happens when rates get down to kind of this level. The question is, can we get that last wave? And by the way, today's another day. Mortgage spreads do their thing. Bond yields are up. We got back to the 435 level. That's where we kind of were right before Jobs Friday. And, mortgage rate pricing, it's like 6 basis points higher from the year-to-date lows, not too much on a day-to-day basis. So mortgage spreads are doing their thing, and people are starting to understand and learn about it. So I feel vindicated about, forcing the mortgage spreads down everyone. He's, his brain all the time. Even some well-known bond traders like, why do you talk about spreads all the time? It's like, homie, I've got to teach people about mortgage spreads and the slowdowns and the 10-year yield and 30-year and, and the 2-year and everything, and, volatility compresses. So I'm very excited for the last few months of the year.
No, and I mean, so you highlighted that in an article last week, and then you highlighted it for the tracker because it was so striking. Like, even no matter what's happening in the bond market, no matter what's going on, the spreads have saved us. Otherwise, we'd be much worse off today for mortgage rates.
Yeah, and I think one of the things that when people were telling me mortgage rates are going to go to 7.5% to 8%, I said, A, you are super bullish on the economy. Good for you. I'd love to hear that, even though they weren't. And it's number 2. It's always funny, like higher yields and rates are a function of the economy outperforming, and yet people just, we always have a joke in FinTwit that if bond yields are going down, it's deflation in a recession. If bond yields are going up, it's inflation and we're going to crash. There's just a group of people in this world that were just born into some doomsday parade and you just can't get out of it. But in any case, bond yields, 10-year yield getting above 5% or anything like that, or the whole, we're broke, no one's going to buy our debt, and all that Mickey Mouse stuff that doesn't happen. But if you're in the 7.5% to 8% rate camp, you're probably not in the spreads are getting better camp either. And the answers that I got, I was like, wow, you've never studied the spreads in your life, have you? And they just go, oh, the Fed, that's the Fed. The Fed bought mortgage-backed securities. And that's the only reason that the spreads never get back. I said, hey, you've never looked at a long-term chart of the mortgage spreads, have you? No, I can tell. Not a very educated, not a very talented man. And you got a bad hair to go with it, man. You should probably move along. Go ahead, out here.
Oh, the bad hair, bad hair on
Sarah Wheeler, we had another clown on X talking trash out there. We always go 30 minutes, homie. Let's go. Face to face, right in front of everybody. Get your forecasts and models head to head with me. Y'all could go to the YouTube comment section and look at me, challenge all those people out there, right? Name, face, model, forecast every single day, 24/7. We are here. We hold everyone's hand. We never sleep. And we love talking about the spreads and the 10-year yield and all that stuff. So yeah, it's a very positive story and it looks very normal. Right. And I think that was the confusion because people were told if the Fed does not get involved, mortgage spreads will never get better. In fact, they could get worse. That was the friction fight going into 2024, that mortgage spreads can get a lot worse, especially if there's a recession happening. A recession does not mean spreads get worse all the time. There's been plenty of times in history that that's not been the case because you're working from an elevated level. So it's really geeky and nerdy things, but I think I think getting people to see what spreads being good. It's for a lot of people, it's their first time they're seeing spreads get better, even with the 10-year yield. So it's shocking to them. It's like, oh my God, it's like seeing a child who couldn't hear for first 5 years of their life. You put a magical ear thing and all of a sudden they could hear and their face lights up and they're like, oh my God, spreads. I get a little bit dramatic about this stuff. I love it.
You do, but we all appreciate it. I'm glad that you love the nerdy stuff so you can dig in on mortgage spreads and tell us what we should expect there. Okay, so the other news that came out today, because we are recording this on Monday, was the builder's confidence. Would love to know what you thought about that.
So by the time this comes out, housing starts will come out. I'm going to be on CNBC early in the morning too to talk about this. And the builders headline data fell. Mortgage rates just got to the year-to-date lows this month, so we're probably 1 month behind in terms of it maybe getting into the data lines. But the buyer's perspective picked up just a little bit, right? And the next 6-month outlook is just a little bit better. What we've seen about the existing home sales market, we can say the similar things about the new home sales market. When mortgage rates get down towards 6%, it's easier, not only just for big or small or medium-sized builders, but I mean, everyone in the housing ecosystem has an easier time selling and buying homes. So the next month, it should pick up just a little bit. The builder stocks have done really well. Even today, some of them were doing well. So for some people, it's confusing. They see this, but remember, a lot has changed. The mortgage rates aren't at 7% anymore, but they're slowly moving down towards 6%. If you could get just 6% rates, what happened in late 2022 and other times, the builders, it's funny because the new home sales purchase application data hit a post-COVID high this year. And before some of the sale adjustment, it was if you take after 2022, it was a multi-year high in sales. But it's very volatile. It's a very volatile census data line. But if you look at it, it's just basically been in a range since really 2018. And where rates go up, it falls down. Where rates go down, it goes up, and it just basically hovers in this area. So, not shocking about the builders' confidence. If housing starts comes out, bad again, it's not shocking as well. But what I'm going to highlight on CNBC is that for the first time, really since 2010, the completed units for the builders are at multi-decade heights to where they stopped building. But we also have jobs being lost in residential construction workers and specialty trade. You put those two together with manufacturing jobs being lost, it is not shocking that we just had the worst 3-month job creation average, really in the 21st century. If you X out, if you have no negative reports, that average was really low. So again, we people are talking about, well, it's just population growth. There's not enough people working. That's not this data line, right? We continuing claims is at 3 years highs. Manufacturing jobs are being lost. Residential, there are weaknesses in the labor market, and it's very apparent to people that track this on a monthly, weekly basis.
What else from the tracker stood out to you? I feel like it was a really interesting week. What were the other things?
To me, I really anticipated a little bit of a snapback. And not only did we didn't get in an active inventory, we didn't get it in new listings. And that's the thing. Again, why do we want new listings back to normal? Because 70 to 80% of home sellers are buyers, right? And if you're not listing your home, supply is a function of demand in housing, right? This is why, it was really good. We saw this year-over-year growth in purchase application because those are sellers. So I thought the easy call would have been new listings data would have been positive year-over-year. And for that to happen, I was like, whoa, really, it's slowing down. The weekly pending sales picked up just a little bit. Our total pending sales data is a little bit higher, but we always have to remember we are working from such depressed levels of existing home sales. It really doesn't take much to move the needle, but if you take the aggregate total of all homes, we're still going to be roughly near, not at 5 million, but near 5 million total home sales. And if we go back in the previous decade, total home sales, roughly the peak, we're not talking about just an average, the peak was near 6 million. So we're missing roughly 1 million mortgage buyers, but if you got 5.4 to 5.7 million total home sales, that to me is more of a normal demand curve out there. So the new listings data was really the shocker because I thought that was the easy layup to show some year-over-year growth, and that didn't happen.
Of course, we are recording this on Monday, but on Friday, we are going to have Fed Chair Powell speak at the Jackson Hole, Wyoming summit thing. That's gonna be really interesting. Does he come out and does he have a hawkish tone? Is he dovish? Everyone's going to be looking to see what he says, and that's going to drive rates to some point, drive the bond market.
We've had some really wild days after Powell talks, and pricing on the 10-year yield has adjusted to the inflation data. And it's basically, it's kind of like we're right at the 435 level right before I got on this podcast. And that's the level that so here it's not because the labor data is booming or anything. The growth rate of inflation has picked up. So we're kind of in no man's land right now. So what does Powell say? But I always say follow the economic data matters more than Powell. The Fed will make their decisions and then they roll with economic cycles. But if the jobs data was booming, if it was just 133,000 per month, we're not having this rate cut discussion anymore. But that's not the case. So it'll be a very fascinating Jackson Hole. He could have an easy layup and say, hey, listen, the labor data is getting softer. We just, we're going to be more mindful of that. Or he could just do what Powell does sometimes, kind of be hawkishly dovish. I hate that terms, but some people like to use it. And we'll take it from there. I think that'll be a good event on Friday to see how the market reacts to what he says. And just remember, his days are numbered. Eventually they're going to name a new Fed chairman out there, and at that point, what Powell says, will have less value. The next Fed chairman will carry a little bit more weight. So Christopher Waller is going to be speaking this week as well. He's one of the head people. So it'll be interesting what the bond market says with him.
We will be paying attention. Logan, as always, thanks for being on. Thanks for giving us your insight, and we will talk to you again soon.
Yes, next time I'll see you in studio.
Yes.